The invention of Bitcoin in 2008 heralded a new era in digital innovation, the blockchain. This revolutionary technology, a decentralized and immutable ledger, has the potential to transform industries across the globe. In essence, a blockchain is a shared, transparent record of transactions maintained by a network of computers rather than a central authority. This decentralized nature offers enhanced security, transparency, and efficiency compared to traditional systems. As blockchain technology has evolved, so too have its applications. From cryptocurrencies to supply chain management, blockchain is poised to revolutionize the way we interact and transact. One of the most exciting developments in the blockchain space is the emergence of blockchain tokens. These digital assets represent a wide range of values and functionalities, from digital currencies to virtual goods and services. The rise of blockchain tokens has led to new opportunities and challenges, prompting lawmakers to create a regulatory framework that fosters innovation while protecting investors. This essay delves into the recent legislative changes regarding blockchain tokens and digital assets. Open blockchain tokens have emerged as a transformative force in the digital economy. These tokens, built on public, permissionless blockchains, represent a new class of assets with unique characteristics. Unlike traditional securities, which are subject to centralized control and intermediaries, open blockchain tokens offer a decentralized and transparent alternative. One of the key distinctions of open blockchain tokens lies in their open and permissionless nature. Anyone can participate in the network, contribute to its development, and acquire and trade these tokens without needing permission from a central authority. This open architecture fosters greater accessibility, transparency, and innovation compared to traditional financial systems. Furthermore, the decentralized nature of open blockchain tokens enhances security and reduces the risk of single points of failure. Transactions are recorded on the blockchain and validated by a distributed network of nodes, making it extremely difficult for malicious actors to alter or manipulate the ledger. The emergence of open blockchain tokens has created new avenues for fundraising, investment, and value exchange. These tokens can represent ownership in decentralized applications, grant access to digital goods and services, or function as a medium of exchange within a specific ecosystem. As the open blockchain token ecosystem continues to mature, we can expect to see even more innovative applications and use cases emerge. Recognizing the transformative potential of open blockchain tokens, lawmakers have introduced exemptions from traditional securities laws to foster innovation and growth in this nascent industry. These exemptions aim to strike a balance between protecting investors and allowing blockchain technology to flourish. One key exemption centers around the classification of open blockchain tokens as securities. Under traditional securities laws, assets are often classified as securities if they meet certain criteria, such as representing an investment in a common enterprise with the expectation of profits derived from the efforts of others. However, open blockchain tokens often operate differently than traditional securities. In many cases, these tokens are designed to be functional within a decentralized ecosystem rather than representing an investment contract. Therefore, exemptions have been introduced to clarify that certain open blockchain tokens, particularly those that have achieved sufficient decentralization and utility, may not be subject to the same regulatory burdens as traditional securities. These exemptions are crucial for fostering innovation in the blockchain space. By providing regulatory clarity and reducing legal uncertainty, entrepreneurs and developers can focus on building and deploying blockchain-based solutions without the fear of running afoul of complex securities regulations. As the industry matures, we can expect to see further refinements to these exemptions as lawmakers gain a deeper understanding of the unique characteristics of open blockchain tokens. Section 4. Blockchain token exchanges, facilitating the future of finance. Blockchain token exchanges play a pivotal role in the digital asset ecosystem. These platforms provide the infrastructure for buying, selling, and trading blockchain tokens, connecting buyers and sellers from around the globe. As the demand for digital assets continues to grow, blockchain token exchanges have become increasingly important in facilitating access and liquidity for this emerging asset class. Unlike traditional financial exchanges, which often operate as centralized entities, many blockchain token exchanges are built on decentralized principles. These decentralized exchanges, or DEX, leverage smart contracts and other blockchain-based technologies to enable peer-to-peer trading without the need for intermediaries. The decentralized nature of DEXs offers several advantages over traditional exchanges. First, it reduces counterparty risk, as users retain control over their funds throughout the trading process. Second, it promotes transparency, as all transactions are recorded on the blockchain and publicly auditable. Third, it enhances censorship resistance, as DEX are not subject to the same regulatory pressures as centralized entities. To further facilitate innovation in the blockchain space, lawmakers have introduced exemptions for certain blockchain token exchanges from traditional financial regulations. These exemptions aim to provide regulatory clarity and reduce compliance burdens for platforms that meet specific criteria, such as operating in a decentralized manner and adhering to robust anti-money laundering and know-your-customer procedures. Section 5. Defining the digital landscape key terminology. Navigating the world of blockchain tokens and digital assets requires a clear understanding of the key terminology that shapes this evolving landscape. Let's delve into some of the essential definitions that underpin this space. Digital asset. A digital asset is a broad term encompassing any digital representation of value that can be electronically traded or transferred. This includes cryptocurrencies, blockchain tokens, digital securities, and other digital representations of value. Digital consumer asset. A digital consumer asset is a specific type of digital asset primarily used for consumption or use by individuals. This category includes virtual in-game items, loyalty points, and other digital goods or services designed for personal use. Digital security. A digital security represents a traditional security such as a stock or bond that has been digitized and issued on a blockchain. Digital securities offer potential benefits such as increased efficiency, transparency, and accessibility compared to their traditional counterparts. Virtual currency. A virtual currency is a digital representation of value that functions as a medium of exchange, but it may not be issued by a central bank or designated as legal tender. Cryptocurrencies such as Bitcoin and Ethereum are prime examples of virtual currencies. Understanding these key definitions is crucial for navigating the regulatory landscape, engaging in informed discussions about blockchain technology, and participating in the digital asset economy. As the industry continues to evolve, we can expect to see further refinements and additions to this terminology. Section 6. Classifying digital assets. A framework for understanding. Classifying digital assets is essential for establishing a clear regulatory framework and ensuring the orderly development of the blockchain industry. One widely recognized framework for classifying digital assets is based on the Howey test, derived from a landmark US Supreme Court case. The Howey test helps determine whether an asset qualifies as an investment contract and is therefore subject to securities laws. According to the Howey test, an investment contract exists if 1. There is an investment of money, 2. The investment is in a common enterprise, 3. There is an expectation of profits, and 4. The profits are derived solely from the efforts of others. Applying the Howey test to digital assets can be complex and requires careful consideration of the specific characteristics of each asset. For example, some digital assets may be designed primarily for consumptive purposes, such as in-game items or digital collectibles, and may not meet the criteria of an investment contract. Other digital assets, particularly those representing equity or ownership in a project, may be more likely to be classified as securities. In these cases, issuers may need to comply with securities laws, such as registering with regulators and providing disclosures to investors. The classification of digital assets is an ongoing area of discussion and development. As the industry matures and new types of digital assets emerge, regulators and legal experts continue to refine their understanding of how existing frameworks apply to this rapidly evolving space.